Hey everyone! Welcome back to our channel. Today, we're diving into the world of investing. We'll break down the basics of stocks, bonds, and mutual funds with simple examples. Let's get started. First up, let's talk about stocks. A stock represents a share in the ownership of a company. When you buy a stock, you become a part owner of that company. For example, if you buy a share of Apple, you own a tiny piece of Apple Inc. If Apple does well and its stock price goes up, the value of your share increases. But remember, if the company doesn't do well, the stock price can go down too. Next, let's talk about bonds. A bond is like a loan you give to a company or government. In return, they promise to pay you back with interest over a certain period. For example, if you buy a government bond, you're lending money to the government. They agree to pay you interest every year and return your principal amount at the end of the bond term. Bonds are generally considered safer than stocks, but they usually offer lower returns. Now, let's move on to mutual funds. A mutual fund pools money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. For example, if you invest in a mutual fund that focuses on technology stocks, your money is combined with other investors' money to buy shares in various tech companies. This diversification helps spread risk. So, how do these investments compare? Stocks can offer high returns but come with higher risk. Bonds are safer but usually provide lower returns. Mutual funds offer diversification, which can balance risk and return. To wrap it up, remember that investing always involves risk. It's important to do your research and consider your financial goals and risk tolerance. Diversifying your investments can help manage risk. If you found this video helpful, give it a thumbs up and subscribe for more investing tips. Have any questions? Drop them in the comments below. Thanks for watching and happy investing.